Welcome to Money Matters. I am Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors, and I am joined as always by DCrowell of Mortgage Network. And we are here to discuss all things where your money matters. And we have been discussing the fact that we are rather sleepy on this foggy, rainy Friday. And so we're trying to pull some enthusiasm into this show. And I think that maybe one of the ways we can do it is to start off by discussing a really exciting thing that's happening right now, and that is earnings season, because that happens 4 times a year. And so here we are in earnings season looking at the fourth quarter of 2017, and good things are happening. So not surprising, as we've seen this very strange, extremely positive 2017 when it comes to equity markets, where you just can't get out of its way. You need to be on the train. And we're seeing the numbers are continuing to be strong as we're going into this earnings season. It's started with banks, which that's really sort of all we've gone through, maybe a little bit of tech, but mostly banks. And banks have been overall relatively strong. Of course, they're even looking stronger as they look at this tax bill. So it's sort of, it's this very, to me, it's very uneasy, because as wonderful as it is to watch everybody's balance sheets increase and to watch the market continue to grow and people prosper from that, it makes me very uneasy, because it's great to plan from this perspective, but there will be some sort of a comeuppance at some point, and I want to make sure that my clients at least are prepared for when that happens, so that they don't overreact to any negative news, because that's what I'm really concerned about. Is we've had so much positive that if we have even the slightest bit of real negative news, it actually has a real impact, not just a blip for a day and then everybody forgets about it, but a real impact that it's not something that causes clients to overreact, get out of the way, and make bad decisions, because we've just been lulled into this very wonderful, passive, complacent, positive state, and makes me very anxious.
The complacent state that Emily is speaking of is the feeling that money in the stock market is rock solid safe.
It's nowhere to go but up.
And it has no place to go but up. And that happens every time there's it doesn't even have to be a bull run. Every time there's 2 or 3 years of continuous growth in equities, stable, growing, stable, growing. Every time there's 2 or 3 years, the general investing public and the media and everybody else stops talking about the risk. And the risk is ever present. The risk is just like a children's fairy tale. It's hiding behind every tree. And we've been on a, 8.5-year run. As
one of my friends says, we don't have tomorrow's newspaper. So if 8 years ago we had foreseen this, I think...
My goodness, what we all would have done different.
Right.
But it is absolutely true that the human component is huge, and everybody has been lulled, or not everybody. I mean, there are some people who continue to worry. Me, one of them.
Me too, and that's what we're the designated warriors.
And but after 2 or 3 years, human beings switch off. After 8 years, you assume that it's like breathing out and breathing in, that the stock market is going to continue up forever. It can't, it won't, and we're at 50-50 right now amongst economists as to whether the inflation which is coming our way. Now this is
we've been talking about it for years. Is coming our way,
we've been talking about it forever, but it is
eventually we'll be right.
It is actually coming our way. Will it be moderate, containable, and healthy? Simply the obvious indicator of a growing economy, or will it be uncontainable and scary and cause a recession? We have economists, the same economists, saying, "Well, I kind of feel that it's both ways. This could be a problem." And the same guy will say in the same article, but in all probability, the inflation is going to be modest and moderate.
Well, of course, that's the safest bet, because if you're looking at interest rates not really moving at all globally, it's that is going to be the safest. That's where I would put my money for sure, because we're not seeing any sort of large ticks up. In fact, if you look at interest rates back, we haven't talked about this in a long time, but interest rates over in Germany and in other areas, and not really developed Europe necessarily, but Germany specifically, their equivalent to our 10-year is at 0.4% or something like that, with ours at about 2.5.
2.58.
So that almost makes the United States look like high yield. It makes us look risky, and that's everything's relative in this, in this world right now. So money is going to keep flowing into the United States for 2.5% yields, because the so-called equivalent risk that's over in Germany is
and we also
barely moving.
This is really interesting. Interest rates are ever interesting to me, not interesting to most
They're interesting
people.
to me too.
But the
Every Friday morning.
2.5% for the Treasury was a great barrier. We burst through that barrier this week. In the mortgage banking world, that's big news, because the market's on a run at the moment. In other words, interest rates are going up. They ticked up 0.1% last week, and they ticked up another 0.1% at the end of this week. So we're borderline 4.25 for the 30-year fixed rate mortgage right now, as opposed to the last 12 months when the rate, whatever it is, has begun with a 3, mostly 3.8, 3.9%. We're at 4.25 now. This is interesting because to Emily's point, the money continues to pour into the United States looking for yield and safety. But the other thing that's interesting is that as long as China, Malaysia, and other great developing nations have balance of payments deficits or surpluses with the United States, in their case surplus, in our case deficit, what do they do with the money? It must be invested in treasuries. That's the hedge. So the great when Mr. Trump says China's manipulating currency and so forth, well, it is, but it isn't. But the financial system is so interconnected now that literally China has no option but to invest almost dollar for dollar in treasuries, whatever it creates in trade surplus.
Right.
So,
despite the fact that there was some thought that China was going to stop investing in treasuries. That was the latest fake news, that even China is using the phrase fake news. That's so fantastic.
Right. It is. It's
going to be in the dictionary soon.
It's going to be in the dictionary soon. But what's interesting is everything says, to Emily's point, everything says that no matter even with some inflationary pressure, which there will be, because the economy cannot keep growing and growing and growing without some inflationary pressure.
Which is a good thing.
Which is a good thing. There will be finally wage pressure, which is a good thing, because what we've all been waiting for is for the 60 or 70% of the economy who have not seen their wages rise will see their wages rise.
That's
so
happening.
These are all good things.
Right. Yeah, all that's happening. The implications of the tax cut are starting to roll into the economy somewhat too. Of course, it's in forecast form right now, but you are seeing companies that are putting their increasing wages. Goodness, this is a great Friday, and they're increasing 401k matches. There's also going to be stock buybacks and things like that. But that the forecasts are definitely trickling down.
Jury's out on that. Because we have.
Well, you are seeing some of it in the announcements that have been made so far.
You're right. You see the announcements, but I mean the $1,000 per employee bonuses for a couple of 100,000 employees was offset by laying off 600 or 800 employees on 2 weeks later. I mean, companies are companies, corporations are corporations.
True.
When the beaver helped the scorpion to cross the river, and then the scorpion bit the beaver, the beaver, as it was dying, said, "Why did you do that?" And the scorpion said, "It's who I am." And corporations will ultimately increase dividends and buy back stock. And there will be only that amount going to the workforce that must go to the workforce in order for them to be labor competitive. In other words, that's it. There won't be any generosity shown there. Let's just put it that way.
Okay, so, and we'll definitely be hearing more about that in the coming weeks as we have more earnings reports. So,
And I must be off for the second half, so Emily's going to carry the ball.
sounds good. All right,
All
we'll
right.
see you shortly. Please stick with us for more Money Matters.